Luskin, do you agree with what Brian Westbury has to say? And in that spirit, Don, there's a survey out, I'm sure you saw it, $86 a share, leaves the S&P worth, what, 14.2 times earnings for the next 4 quarters, which is historically very cheap, all the way going back to 1990. What do you make of that?
I don't believe that's factual, Larry. I think that other than a few crazy years between 1998 and 2002, the kind of forward PE ratio you're talking about is actually quite typical. In fact, a little bit on the high side. It was lower than that in the summer of 2008, and I don't think that would have been a very good time to buy stocks.
Well, besides the Lehman, they do say, besides the Lehman episode.
No, I'm talking about before it. I'm talking about the whole summer before it.
Well, I don't know.
That got even cheaper after it.
That disagrees with this article. But
yeah, well, I just don't know where they get these numbers. As far as I just think they're completely wrong.
All right,
Sorry.
but is there a V-shaped boom in profits, and is there a V-shaped boom to come in stocks?
Well, when we say V-shaped boom, it's really not really all that clear what it would mean. It's kind of a slogan, right, rather than a scientific description. What I take it to mean is that going back to the kind of business cycle behavior we've been used to all our lives, when you have a very sharp downstroke, you have a big race back up to the long-term trend. And that's been true throughout our lifetime with business cycles. But I don't think what we've been through is a business cycle. I think we've been through a credit crisis. And that's something that we really haven't seen during our lifetimes. And historically, if you look at the evidence going back hundreds of years around the world with credit crises, like Reinhardt and Rogoff have come up with in their great book, This Time It's Different, you find that credit crises behave differently than business cycles. It's harder to get out of them. And so what it would take right now to get back to trend, either in full employment or GDP, would be back-to-back 5%, 6%, 9%, 10% GDP quarters. And we haven't seen that. I don't hear anybody calling for that. Where's it going to happen?
I think, Brian, you think there could be 5 to 6%. You don't see 9 or 10.
We just had 5.7 in the second quarter of this year. We're going to have 6.
3 quarters of which was inventories.
We're going to have, it always is. They go back and look at every recovery, Don. The bottom line is the last panic we had, I think it was a panic, was 1907. GDP fell 15% in 1907. It came back 15% in the year after that. So it was a V-shaped recovery, and I think that's what we're seeing right now.
Down 15 followed by up 15 doesn't get you even back to where you started. And it certainly doesn't get you back up to trend.
I was shortening myself for TV. You know?
All right, let me get
the other thing is consumption right now. Consumption is at an all-time high. So,
services. Excuse me, wrong. Services consumption is goods consumption
I said
is
consumption.
not.
Time out. I want to ask you, gentlemen, just real quick whip around. We're going to come back. Which is more important, profits in the V-shaped recovery or financial regulation bills to the stock market? Stefan, you first. Profits?
Profits will trump everything.
Brian Westbury.
Yep, profits, productivity, and growth.
All right, Don Luskin.
Look, profits define the level of the stock market, of course, but bad enough financial regulation eventually will crush profits.
Do you expect bad enough, or do you think this bill is not going to really amount to all that much, Don? That's possible, too.
The biggest risk is that it becomes a regulatory blank check where we give a new Financial Stability Oversight Council carte blanche to declare any company in America systemically important and break it up without judicial appeal. That is what's in the Dodd bill.
All right, hang on. We're going to come right back and talk about that. That's a pretty strong indictment.